Every time the economy crashes, we're told the same three things. This was unexpected. This bailout is temporary. This is to protect ordinary people. But here's the question almost no one asks. If bailouts are meant to stop crashes, why do crashes keep happening again and again, each one bigger than the last? Think about it. The Great Depression, the savings and loan crisis, the dot-com collapse, the 2008 financial meltdown, the COVID rescue, the quiet bank failures happening right now. Different decades, different excuses, but always the same solution. Trillions of dollars appear overnight. Markets are stabilized. The system survives, but the damage never disappears, it's just moved. So what if this isn't a series of mistakes? What if endless bailouts are the result of a silent agreement? One that was never voted on, never debated publicly, but now quietly governs the global economy. An agreement that guarantees rescues, encourages risk, and ensures that when the system breaks, you pay for it. To understand how we got here, we have to go back long before 2008. Back to the moment capitalism quietly changed its rules. The modern US economy runs on a fragile promise: confidence. Banks lend money they don't fully have. Governments spend money they haven't collected. Markets price assets based on expectations, not reality. As long as people believe the system will hold, it works. But when confidence breaks, everything fails at once. That's why bailouts exist, not to reward success or punish failure, but to prevent panic. And here's the critical part most people miss. Once bailouts become expected, behavior changes, risk increases, leverage grows, accountability fades. This isn't some conspiracy in the shadows. It's policy logic taken to its extreme, and over time that logic hardened into an unspoken rule. Major financial institutions will not be allowed to fail. That rule is the agreement. After the Great Depression, the US tried something radical: restraint. Banks were tightly regulated, risk was limited. Speculation was separated from everyday banking. For decades, this actually worked. Crises still happened, but they were contained. Then came the 1970s. Inflation surged, growth slowed. Political pressure mounted. Instead of limiting risk again, policymakers chose a new approach: manage crises asterisk. This was the first line they crossed. The idea was simple: let markets grow freely and only step in when things go wrong. But markets learned quickly. If intervention was guaranteed at the bottom, then taking huge risks at the top became incredibly profitable. By the 1980s and 1990s, finance stopped serving the economy and began dominating it. Banks merged into giants. Balance sheets ballooned. Debt exploded. New financial instruments promised safety while hiding massive amounts of risk. The system became so complex that even regulators couldn't fully understand it, and that complexity became a form of protection. Because once the failure of one institution threatens the entire system, failure becomes unacceptable. The agreement matured. Growth through credit, stability through intervention, and losses spread across society. Everyone believed they were managing risk. In reality, they were just accumulating it. The 2008 crisis didn't shock policymakers. It just forced them to admit something publicly they already knew privately. If major institutions failed, the entire system would collapse. So the bailouts came fast, and they were massive. Trillions in guarantees, emergency lending, quiet backstops, and something crucial happened next. No meaningful punishment followed. No systemic downsizing. No real accountability for those at the top. Markets understood the message instantly. The agreement was confirmed. From that moment on, risk was no longer symmetrical. The upside belonged to private actors. The downside belonged to the public. After 2008, the economy didn't heal, it adapted. Central banks expanded their role. Asset prices became a policy concern. Stock market drops weren't seen as corrections anymore. They were treated as emergencies. Then came 2020. In response to COVID, the US government and the Fed created more money in a few months than they had in the previous decades combined. Markets soared, asset prices exploded, but wages lagged, debt ballooned, inequality deepened. Once again, the system survived by pushing the cost forward. After every crisis, reforms are announced, new rules, stress tests, oversight committees, but none of them address the core problem. The expectation of a rescue remains untouched. Banks are still massive. Debt still grows faster than income. Markets still price in the next intervention. Because breaking the silent agreement would mean allowing a collapse, and collapse threatens confidence. So instead, policymakers choose to delay stability today at the cost of instability tomorrow. Just look at today's landscape. Record government debt, fragile regional banks, asset bubbles fueled by cheap money, markets that have been trained to expect the rescue at the first sign of trouble. The pattern is unmistakable, and history tells us something uncomfortable. Crises don't end systems. Belief does. As long as people believe the bailouts will work, the system can continue. But every rescue requires more debt, more money, creation, and more faith. And faith, once broken, doesn't come back easily. So let's break this down into 3 simple takeaways. First, bailouts don't prevent risks. They reward Italiano. When rescue is guaranteed, it changes behavior at every level of the economy, encouraging bigger and bigger bets. Second, these crashes are not accidents. They are designed by incentives. The system produces them naturally because the rules of the game make it profitable to do so. And third, the real cost is hidden until it's unavoidable. Inflation, inequality, and the national debt are how the burden is silently transferred to you. This leads to the final, critical question. What happens when confidence finally runs out and the silent agreement can no longer be honored? Because financial systems don't collapse when they run out of money. They collapse when people stop believing the promises behind it. If you want to understand money beyond the headlines and see the patterns before they repeat, subscribe to the channel and share this video. The next bailout won't come with a warning. It will come labeled as necessary. And by then, the agreement will already be in force. Thanks for watching.